in order not to face that agony of indebtedness. So I think I will stop here. Thank you.
One very interesting point that Dr. Bhandari made, which resonates very powerfully, is about your neighborhood and yourself. But if you even take that up away from the individual level or your local level, I think I was speaking specialists, and we were talking about the geopolitical situation around India. As you know, it's called India lives in a ring of fire. And he said that sometimes we hear that India behaves like a big brother, etc. He's saying the only way we're going to be able to live in peace in this region is if we do what we're doing for Bhutan, which is to help it to develop. So the same thing with Nepal, the same thing with Sri Lanka. Sri Lanka is falling into China's embrace because we haven't done enough for it. And he was citing some private conversations that we had with the political leadership there. But it actually comes down to the same thing. We have to have a vested interest in their success if we are to succeed. Because otherwise there are always going to be those guys who are on the outside looking and saying, oh wow, you guys are growing at 10%, we are growing at 4%. You're going to, get your people out of poverty, we're going to be stuck here in the cycle of terrorism. So I asked him about Pakistan, and he said, trust me, the establishment there also wants the same thing. They don't want this perpetual cycle of conflict. Whatever you see in the newspapers and the media is one part, but the other part is really they also want to come out of it and they don't know how, and maybe we can play a role in it. So I just thought of sharing that in that context, is taking that individual context and making it geopolitical. So, ladies and gentlemen, I'm going to make a slight change in order. Dr. Jalan is with us till about 12:30 or 12:45, and hence I'm switching the next page, and with the kind permission of Mr. Nair and Dr. Mohapatra, who have agreed for that change. So I'm going to now request Dr. Jalan to speak. Dr. Jalan, as all of us know, I'm going to do this as a formality, all of us know him, but he was Governor of the Reserve Bank of India from 1997 to 2003, which was a very interesting time in our history. He was a member of the Rajya Sabha from 2003 to 2009. Earlier he was Finance Secretary as well as Chairman of the Economic Advisory Council to the Prime Minister. He's represented our country on the boards of both the IMF as well as the World Bank. He's been associated with every academic institute of repute in the country, ranging from ISI in Calcutta to the Institute of Economic Growth in Delhi as Chairman and NCAER in Delhi as President. He's currently Chairman of the Center of Development Studies in Thiruvananthapuram. Ladies and gentlemen, as you also know, that he is now Chairman of the Expenditure Management Commission that was appointed by the Prime Minister. Ladies and gentlemen, please put your hands together.
Thank you, Kaushal, and my apologies to Mohapatra and Mr. Nair for having proceeded with the magic mail, and they are now so that they can take the risk of listening to me before they leave the room. Now, what I wanted to know, I've been doing a very dull subject, macroeconomic perspective on risk. This physical science of economics. So I will give you some perspective on macroeconomics so far as risk is concerned. I mean, obviously, it doesn't have to do very much with businesses, corporates, and we have some great experts here. You have heard three superb speeches, and which also gave me knowledge. I can tell you that we have all been through a lot, but my career as well as my education has been economics. So most of the time I've been dealing with not administration per se, management, or finances per se, but either regulating finances or borrowing from the markets or deciding what the market can do. So that was much easier than actually doing it. So please forgive me if I go this macroeconomic perspective. Now, you have already had two brilliant speeches and cautious opening remarks, so I don't want to take too much of your time. But one thing that I want to emphasize from the risk point of view, and so far as macroeconomics is concerned, that it's absolutely important to distinguish between the short term and the long term. How you look at risk and how you manage it depends, the assessment of risk, on whether you are dealing with the macroeconomic situation and how you deal with the macroeconomic situation to handle risks. Whether you have a short span, that is, you are investing or you are buying or you are doing something which is for a short period, financial risk, or whether you are investing for the long term. And they are two completely different things. Now, if you are taking the short term, so far as macroeconomic situation is concerned, you would have to take the present into account. It's a very interesting issue. The present in the sense that if you have a 1 year horizon, say, short-term horizon, then most people would probably invest in liquid assets, rather than capital structure, investments, and so on, which can take a longer gestation. And in our situation just now, given the macroeconomic picture, at the moment, unfortunately, is mixed. If you take the short view of macroeconomics and managing macro, your risk within an area also, then as you can see, the macroeconomic situation is not all that great. Our expectations are very high just now with the new government in power. A majority government after 25 years of short-term governments. It is a surprising thing about India, and the one thing that we can be very proud of, that despite that history since 1989, India remains a great democracy, the world's largest democracy, one of the freest democracy, with the largest population in human history, which exercised their votes. But for 25 years, the votes were exercised. We had compulsions of coalitions, which were the favorite term for policy paralysis in those days. That there was a compulsions of coalitions, multiple parties of governments, and 4 of them, of course, were in power for 5 years, and that is the BJP government, the Bajpayee government, and the Congress government. Although they were all coalitions, and they were in terms of the length of time they stayed for 5 years, but they were coalitions, and they could be, they were supported in majority on their own party itself, as now, but they had majority with the help of some coalitions, which may have affected, not affected, and so on and so forth. The point why I'm making to you is that the last 25 years were very different from where we are now. For the first time, we had majority government. After 25 years, with a majority, we always had a majority government with a coalition also, with the government in majority. But this belongs to one party, as it were, NDA or BJP. So it gives us tremendous opportunities and expectations. At the same time, if you take the short view, as you know, as investors, as financial experts, all of you are waiting, as it were, before you take risks of investment in the short term. Our growth rate, as you know, is lower than what was envisaged. Our industrial growth, unfortunately, manufacturing and industrial growth is 2.4% or something in the first half of this particular fiscal year. GDP growth in the range of 5.5%. So these are extremely troublesome developments. At the same time, the positive development is, of course, that foreign exchange, the trade deficit, what you may say, the total current account deficit has subsided. Earlier we have been financed by liquid short-term flows. We are actually financed by short-term liquid flows. And you could see the volatility in the situation that we had in the exchange market and so on. But today, fortunately, that is gone. Our reserves are high. There is certainty, more certainty. So you can see, if you look at the foreign markets, or if you look at India's, although people are waiting to see whether we can deliver on what we have announced, what we have said, but there is a positive movement, both on current account deficit side, as well as on the current account deficit and inflation. These were two big problems 6 months ago. Now you see due to whatever it is there. And uncertainty, of course, is still there about monsoons and a lot of difficulty and so on and so forth. But the point that I want to highlight here, if you are taking a short view in terms of investment, you can now at least take for granted that the government will stay. At the moment, the policy framework, the policy outline is not clear. A lot of announcements, but we are all waiting for what people refer to in the media, a big bang or something. But I don't think that is essential. So my suggestion in terms of risk from the macroeconomic point is that all that is happening in the macroeconomic area at the moment is low, and it can only get better. It can't. I don't think, if you look, say 6 months, we are past 6 months or 6 months of the present government. If you look down for another 6 months, if you're going back and thinking about your short-term risks, the risks in terms of investment, etc., are likely to be relatively low. Of course, in terms of the assets that you choose to invest in, or the kind of financial sort of assets that you want to create, that may still be different and guided by a short-term interest or a long-term interest. So this is the first point that I wanted to highlight, is that risk assessment in the macroeconomics has to be based on both criteria, short-term and then the long-term, and it depends on whether you are looking at short-term or long-term. I mean, why was it that in India, last year, the same year, with a government, with one of the most famous persons from my profession, people didn't want to invest. Now, with the new government, with Modi ji, there is still uncertainty about the so-called reforms and so on. But it looks to me that whether you take short-term or the long-term, we are in an extremely healthy position. At the moment, the macro statistics that you are seeing don't tell you that. And at the moment, if you were to ask, what is the short-term outlook, people will be waiting for the budget. There was disappointment for the last budget. People would be waiting for the budget. The government at that time was only 1 month in office or something like that. Now, hopefully, that we will see some measures which crystallize what they have announced to do, like, for example, administrative reforms and so on, which are very extremely important in our system. Now, let me move to the long term. So far as the long term is concerned, if you were to take the macroeconomic situation in the long term, the one point that I like to emphasize as again, sorry, it's a dull subject, but it is so, from the economic point of view, that India's fundamentals are huge. And you talked just about balance of payments. And when we were having an informal discussion, just waiting for the meeting to begin, we were saying why the same things that happened in the recent years in terms of balance of payment didn't happen earlier. The main problem was that our freedom to take policy action, which would have long-term impact, was extremely restricted because of the BOP issues. We were borrowing, US was a very powerful determinant of whether you could borrow or you could not borrow. We could not borrow from the private market because we had balance of payment difficulty. So we were dependent on World Bank and IMF. And World Bank and IMF, as you know, where the highest majority was of US. You had proliferation, nuclear thing. So there were all those kind of things where, there was a tremendous amount of problem. But because if you wanted to reform, you needed support. This is a very interesting thing, how it is a two-way relationship. I can tell you from my personal experience in government and outside for a fairly long time, that there was no opposition to reform per se after 1979. When Mrs. Gandhi came back to power in 79, there was a move towards reform, and you saw some reforms at the level of imports and at the level of others, but we could not drop the licensing control, we could not reduce the tariffs. Because if we reduce the tariffs, imports would flow. We didn't have the university capacity, and so on and so forth. Now, what I want to say today, in terms of savings, I think my friend mentioned this point. India has 30% savings. The global environment is very disturbing. The US, Europe, Japan. But we are not as dependent on trade as many of the other countries are. So sometimes, everybody wants more exports and everybody wants to be able to be exporting countries, so do we. But the fact that trade is a relatively small proportion of your GDP gives you the freedom to invest, and we need those investments. And you have the capacity to invest because you have got savings, and you have the capacity to invest. Now, why capacity to invest? Which is the pioneer among developing countries in technology? India. So you've got capital. You are not dependent. Global, what happens worldwide affects you in macroeconomic terms, yes. But you are not as dependent on trade or exports as, for example, China. China is also coming down. So we have that strength also, that we are a bit, not decoupled, less dependent on demand and supply. We can do our investments, we can do what we want. So the IT, then labor. In terms of labor, wage costs, labor-intensive industries, we have a tremendous advantage. So if you look at India's comparative, macroeconomic comparative advantage today, say compared with those balance of payments scheme, your reserves are very good. You can import what you want. Your imports are free. You can import as much capital as if you take a long view. You have majority government. Policy reversal can happen, but unlikely once it is approved by the cabinet. I'm not saying that policy reversal cannot take place. But earlier, you had people clearing ordinances. That's not going to happen today. In the 5-year period. I'm talking now about the risk perspective over the 5-year period. And I'm telling you that in terms of fundamentals, India has all the, what you might say, what the economists call the factors of production. So if we have a manufacturing growth rate of 2.5% or something today, I hope, with your help, our country will get on to 10% manufacturing growth. And it can. If public investment increases, if private investment increases, if there is confidence, rather than waiting and watching. People are now waiting and watching because in the last 8 years, somehow, didn't deliver what we promised. But in terms of the basic strengths of the Indian economy, Indian macroeconomy, there is nothing that you cannot handle. Just imagine drought. This same country went through droughts in 65 or something. And we were going around with a begging bowl. Today you can import food. You can import pulses. So what stops us? You've got the talent. You've got the capital. The government is saying, I want to build infrastructure. Go ahead and build it. So today, I mean, I'm sorry, individual at the sectoral level, at the firm level, there is always risks, and you've heard all the things there. I'm just talking about the macroeconomic, and which was I was asked to. So I would simply say that from the long run point of view, that is, if you take the 5-year perspective, say India 2020, on which DLB has written a lot, and it's an excellent book, then all the fundamentals are there. Now what are the problems? The major problem, I believe, is the very administrative bottlenecks and extremely complex system of obtaining various administrative approvals. And this is important. People are used to an India of the BOP age, when people don't understand the administrative complexity of 20 ministries and 13 something and 14 something. Now, as citizens of this country, if you start looking at the map of the administrative complexity of India, we rank at the bottom. The same democracy, the same country with the highest savings, technology, reserves, but administrative system is the bottom. It's a political issue. Political power, because it gives you political power. That's a very extremely important issue. And therefore, that remains the doing business, the index of doing business and so on is still extremely low. And this is the major challenge to our country, is how to simplify that. Now, this is extremely difficult to take. Why? Because supposing you take away the land allotment power from state governments, then the power of the states, different parties, different things, and you need those votes in that assembly. You need those votes for Rajya Sabha members. What does the center do? It's our own creation. I'm speaking it. As citizens, I can say that there is nothing in terms of fundamentals to stop it. But the administrative structure is still of the colonial age. All the power cemented, tremendous vested interests, and you haven't seen any change in that role. Now ask yourself, the same country, the same people of India, the same government which can give you the freest and the largest elections in human history cannot give you infrastructure. Why? The difference is the election commission doesn't have to report to the whole ministry. If you had a national highway authority, if you had a power finance corporation, which did not have to report to the ministry, the ministry can decide the policy. It has nothing to do with changing the political shape. But why does everything have to go to the minister to be approved? Think about it. So what I mean is that we have to, in the long run, think about a change in the way we manage our business. India is a federal country, central states. The states have a large number of parties governing their different states. And then you have center. And combining these two, the state is something with somebody. This can all be taken care of. If you follow, if the central government follows, then the ministers will make policy. Ministers will monitor development. Why is it that capital projects can't be completed? The macroeconomic one. Tell me. You've got all the resources, you've got everything that you want, and yet it can't be completed. Because of the permissions, if you're in the private sector. Because of licensing, if you're in the private sector. Because of inability to deliver, if you're in the public sector, because you have to run to the minister. Can I put a power plant in Andhra? Go to the minister from Karnataka. Can you do this? Can you do that? So this is the biggest challenge that I see. And in this perspective, if I can just conclude by talking about risks, that is in the long run perspective, there are different risks. Is that in the system which arise. And again, let me just highlight this regulatory risk. Now, so far as banking is concerned, you would have seen that banks, there are, the Financial Stability Board in the US, the Basel III, etc., they have come, which have made it much more stringent after the 2008 crisis in the US. For the banks to have, the banks now required to have much higher loss absorbing capacity, the so-called TCAP, total cost absorbing capacity, and it's all because of the 2008 experience. Nobody expected that loose policy, etc., banking, and so in the banking, all these things are there, and then of course your liquidity requirements, CRR, etc. But we have two additional points. That there is government borrowing, which is very high, fiscal deficit, social finance borrowing. So there is a restraint. Real interest rates are high, therefore are higher. They're all high. But there is no lack of resources. I'm making this point about the regulatory thing. And fortunately, also far as the banking side is concerned, and I'm sure the insurance side also, we have the leaders here, that we follow totally international norms. This was a change which we brought about, although we used to be closed economy and so on, but we brought about it in the Basel and so on, earlier, Basel II, Basel II, that all the requirements for our banking system would conform to best international standards. Except for the bonds ratio and the CRR 2.6, the bond requirement which are compulsory. And you would be surprised that the Indian banking system is really got one of the best. It's open, and there's no problem. And all of you are involved in this, you have seen that everything happens, which is positive. Then we have the company law issue from the risk point of view. It's not risk-free, because if you read 3, 4, 5 lawyers to tell you what you can do and what you can't do on the company law. Then of course we have the state. You may have a policy which is announced by central, but it will be on the concurrent list, or it will be central list. Still, the states have to do this. So the issues are very involved. Now, let me just stop here, because what I'm trying to get at is that so far as long-term is concerned, most of the risks are of our own doing. So from looking at it today, the same provisions, the same capacities existed 5 years, 6 years, 3 years ago, but we didn't utilize. Today we have the great advantage of having a government which is accountable, which is responsible, which is elected by us. We have a system of separation of powers between the judiciary. You have as much right as Mr. Modi or Mr. Sonia Gandhi or whoever to go to the court and to for the same law would apply to you as to them. So I think that there are tremendous advantages, both in economic terms and also in terms of judicial side. The major problem is the administrative bottleneck, as I suggested, and this company law is going to make it much worse. The central state division of powers, which is going to make it much worse. And above all, that we have taken so-called liberalization in the markets, so-called more competitive environment and corporate freedoms and so on. But the government's intervention in day-to-day economic policy making or investment remains the same, as was the case when we had all these more. So that's the nature. Yes. And how you handle it, I don't know. Thank you.
Sorry to
take so much of your time.
Thank you so much, Dr. Jalan, for a thought-provoking address. It's, you know, when all our risks boil down to a single risk, which is, at least in the macroeconomic context, which is administrative, you know, I think we can suffice to say that we live in fairly good times. I don't think we'd be having the same conversation 15 or 20 years ago. It's just such a refreshing, change that's happened. I'll give you another quote. Dr. Jalan explained it very elegantly, of course, giving the macroeconomic framework, etc. But the guy in Bombay, whom everyone really goes by, what we call the big bull of Bombay, and Ashish will have to pardon me for this. Rakesh Jhunjhunwala, when he was saying, he went on to say that we are in for the mother of all bull markets in India, given this confidence. I think the framework for that confidence, or the foundation for that confidence, is what Dr. Jalan has said, that from the standpoint of where we are, the only way is up. Dr. Jalan said it very, very elegantly. Mr. Jhunjhunwala said it in his own market-driven language, which is to say we're for the mother of all bull markets. And I think they're both, the important thing is that they both segue in, they both blend, that one becomes the foundation for the other. So on that note, I'm actually going to bring in our next speaker, Mr. R.K. Nayan, member of Finance and Investments of IRDA. His earlier assignments were as Executive Director of SEBI, General Manager of Corporation Bank, and Managing Director of Corp Bank Securities. He is a keen trader. He's delivered lectures on development of money and debt markets, energizing the corporate bond market at various trading centers across the country. That actually is a major burning issue, the energizing of our corporate debt market, which we really don't have that deep a market there. He currently serves on the RBI Technical Advisory Committee on Money, Foreign Exchange and Government Securities Market, SEBI Corporate Bonds and Securitization Advisory Committee, the FSEC Subcommittee on Early Warning, International Association of Insurance Supervisors Committee on Financial Stability, etc. So you couldn't have a better person to talk about financial stability. He's a postgraduate in Science, Law and Management and has a diploma in Securities Law from the GLC, the Government Law College, Mumbai. He's also a keen wildlife activist and an avid golfer. Ladies and gentlemen, please welcome Mr.
Jalan and distinguished fellow panelists. First of all, I must thank the organizers of this program, Dun & Bradstreet and Reliance Capital, who have invited me to address this session. I must say that I'm running a huge risk now because after listening to some eminent speakers from in the morning, I don't think I have much to say because they have covered most areas of risk. You have in the beginning one of the speakers talking about the VUCA and then the interconnectedness of risk, and then the fact that our friend from the Bombay Stock Exchange has given a very wide perspective. In fact, some of the things which I had to speak, he has already spoken. But anyway, I thought I should share this thought with you. This is a book on risk. I think it's worth reading, Against the God, The Remarkable Story of Risk. And there's another book called Bull by the Horn. It's written by an American regulator called Sheila Bair, who is the former FDIC chairman. And the battle she had to fight in the United States to, against the implementation of Basel II, advanced Basel II, it makes an interesting reading from the regulatory perspective. I thought I would share some few experiences because I've been a banker for a long period and I have run a primary dealership for some time, and I have actually experienced volatility in the markets. And I must say that during the period when Mr. Bimal Jalan was the Governor of Reserve Bank of India, 1997 to 2003, I was actually running a bond trading house. And we did see some deft macroeconomic, monetary policy initiatives by a person whom I admire a lot. He actually revolutionized the foreign exchange side of the Indian market. The financial markets in India have always been, subject to a lot of volatility on the foreign exchange side. It was during his tenure that I think the reserves of the country, which was at about, say, 1 or 2 months in 1991, steadily it was built up, and there was a sequential reform in the financial markets, particularly the foreign exchange market. It was there in the money and debt markets also, but in fact the government security market reform also happened, the money market reform also happened. But what happened in the foreign exchange market at that time was a story, I think, which you should all understand, was a remarkable story. A couple of people in Reserve Bank of India did a deft macroeconomic monetary policy management, and they were able to bring stability. Most of the time, what used to happen was when there was a crisis, a balance of payment crisis, or there was a war, or there was a problem, you would find that the rupee would suddenly become volatile. And there were, impediments at that time. We didn't have much of a reserve currency at that time, but the reserves were built up steadily. And it was built up by actually liberalizing the exchange rate management. They started with the LERMs and slowly went into a full-fledged, open market with controlled volatility. And there was something called the managing the foreign exchange rate. I think it was handled superbly because we increased our reserves. Suddenly the reserves went up to 5-6 months of imports, and that brought stability. And I remember in 1999, a huge, or 2000 it was early, when measures were taken actually to bring down volatility in the foreign exchange market, interest rates were brought. That was the last time. After that, in 2002 there was a war, in 2001 there was a big problem, but Mr. Jalan didn't raise, didn't bring any interest rate change. He managed the foreign exchange crisis using the reserves, which were built up over a period of time. So you can see how good central banking and good policy making can actually contain volatility. The Indian financial markets are extremely volatile these days. And being a primary dealer, I have seen my portfolio suffering huge losses suddenly. If the interest rates suddenly go up, you are sitting on a, say, profit of 100 crores on a portfolio of, say, 1,000 crores, and suddenly you find that the interest rates have gone up, and all your, profits have just vanished. And I can share an experience with you. We did buy what is called a value-at risk model at that time. I'm sharing this experience, and I was looking for a model which would throw out risk. And then I contacted a person who was an economist, whose brother had actually developed a program of value-at risk. He was working for the Indian School of Business, and he came and explained to me how this value-at risk model works. He said there are 4 models. One is called the historical model, which actually Ashish explained. It measures, say, 300 days or 1,000 days of volatility. Then the variance and covariance model. And there was something called the extreme value model. And there was something called the Monte Carlo simulation model. All these models threw out different risks, figures. And my dilemma was, which one should I pick up? Should I pick up a conservative model? Most primary dealers went for what is called a historical risk model. So they give you 1,000 days or 300 days volatility depending on your requirement. And it was showing some risk figures. And then I looked at other competitors. I was a young chap those days. I wanted to take higher risk and make more profit for my shareholder. I was from Corporation Bank, and they gave me a 50 crore capital to play around in the market. And my chairman was very, he said, you take some risk and make money in the government security market. The government security market fairly stable. We had a very good carry. We used to borrow money at, say, 7% and get about 12% on the government securities portfolio, which carried 5% spread. It was a very cozy life. One fine day, the interest rate went up in 2000. you found that your portfolio, the interest rate shot up to 14%. And then the models were showing different risk. And I had selected what is called an extreme value model. Now the extreme value model was only capturing the risk in extreme cases. And it was showing a very high loss in my portfolio. And believe me, when the markets went bad, there was no buyer. At that time, we didn't have a very deep government security market. So if you wanted to sell one, and also there was only one buyer, that was the Life Insurance Corporation, and you would quote a very high price because he had the liquidity. So liquidity became a thing at that time, and you had problems in actually selling off your portfolio. The second issue came, how do you fund this portfolio? Now you have a leverage, you have 100 crores of capital, you have 1,000 crores of portfolio, you have borrowed 900 crores in the money market those days. It was call money and repo markets which existed. And there also the rate shot up to 16, 20, 30%. So suddenly you found from a comfort of 5% assured spread, you had a negative spread and your portfolio had actually depreciated. What I'm trying to say is the volatility in the market, the ability to measure and manage risk, all these models, you can pick up and choose. And I had the good fortune of buying a model and then selling it first to my management, to my top management. Most of them didn't understand this, what kind of figures they're coming out. I could sell it very easily. Then I went to the regulator and explained that they were also happy with the model because there was another primary dealer which was also using the model. But then when the extreme value happened, you found suddenly the models didn't work. There was a problem, the liquidity was the issue. If you had money, you were a king. And you could actually buy securities at a very cheap rate. The interest rate suddenly went up, say government securities went up to 13%. Say it was about 11%. Now that's a big thing, 2% increase in interest rate on a 20-year or 15-year security. Your portfolio can be wiped out, or a 1,000 crore portfolio, you could have a loss of 200 crores, your capital is gone. But then we took some strength saying that this could be a short-term measure, and we didn't buy at that time. We purchased two securities. I still remember that security. It was a 1232-2012 bond, where I got it at a very high yield. I got about 13%. So I purchased 20 crores of that and kept it in my portfolio. My chairman said, how come you're buying this in this bad market? I said, sir, it will come in handy someday. After that, the volatility went off. The interest rates started coming down. By the end of the year, the portfolio which was having a loss suddenly became, magically we made a profit of say 100 crores that year. By trading in government security, the volatility disappeared. But the fact is that we had to undertake the risk, the liquidity risk, and the fact that the reputation also. Suppose somebody was looking at your balance sheet and saying, how come you're running a portfolio like this? You are a very prudent person. I had difficulty in explaining to the board, but then we did manage and come out. What I'm trying to say is there are limitations to models, there are risks in models, and a lot depends on three things. The financial crisis did teach me two lessons. I was in SEBI those days when the financial crisis happened in 2008, and unfortunately I was the executive director managing the mutual funds. And that was a period when the mutual fund industry underwent another crisis. But since I had experienced this crisis in the primary dealership, I did tell my chairman at that time that, sir, the problem is of liquidity and we need to give liquidity because the underlying assets are very good. It's only a short-term liquidity crisis, it's not a solvency crisis. Therefore, we went to the central bank and requested the central bank at that time that you please provide some funds to the mutual fund industry. And believe me, when the central bank actually gave a 25,000 funding to the mutual fund industry, and that time the insurance industry, the liquidity plus industry, they have money all the time. They had money and they were buying. But the securities industry, which was actually most mutual funds, ran on a capital of 10 crores. So on a 10 crores, you could have a portfolio of 100,000 crores. But once there is a volatility, and what happened in the US, funds like the money market funds became negative after the Lehman crisis. So even money market funds were giving the buck, actually the buck got broken and people incurred losses on short-term money market funds. So imagine what was happening on the portfolio. And there was a banking problem also. The private sector banks, certificate of deposits became totally illiquid. And the rates of the paper just shot up. And there was no buyer also. So there was a liquidity crisis and the interest rates had shot up. But once we got liquidity from the central bank, we looked at the portfolio of the mutual funds and gradually the financial crisis was contained because they were able to sell without creating much asset volatility in the market. Therefore, these are some lessons I learned. I came here trying to talk about insurance, but having heard some eminent speakers, I thought I should share some thoughts with you on how risk is in the financial market, say it is credit risk or market risk or interest rate risk or the use of derivatives, can cause serious problems when there is a perfect storm in the market. And how less we know about risk is something which you should learn, because when there is a perfect storm, all your lessons you learn in risk management go for a toss. Suddenly you find that there is no money in the market and everybody looks at each other with suspicion. And at that time, all the regulators globally, including the Indian regulators and the policy makers, work together to build confidence into the system. It is this ability to build confidence into the system and bring asset prices volatility that will actually contain the financial crisis in the future. As far as my job presently in insurance is concerned, I am actually handling the investment portfolio of the insurance companies, and my experience in banking and the securities market have come in quite handy. We have come out with a framework of investment regulation which is fairly robust in terms of the asset side of the balance sheet. Now, insurance is a funny kind of animal, because the liabilities are something which are estimated by the actuaries, and most losses come not from the asset side, though they do happen in some. If you are imprudent investment, you will lose money. But the ability to price your product and manage claims, that is the underwriting risk, is the main risk which happens in insurance. And in IRDA, we have a fairly robust policy of approving the products of the insurance companies, whether they are life or general or health insurance companies. We are hoping that, because it's a capital-intensive industry, a lot of capital is required for growth in the insurance industry. We are hoping that, the current, there is a lot of debate on the legislation of the new insurance bill, and we believe that it would be good for the industry if we are able to bring in more capital into the country, to bring more stability to the insurance sector, and manage that kind of risk, which is particularly peculiar to the insurance industry in terms of their ability to bring in more capital and be solvent to meet the liability of the policy holders. We have adopted what is called the IAIS standards. There is an agency called the IAIS which actually sets standards. We are also looking at two things for future. One is adopting the international financial reporting standards for accounting, which the government has said that for the next budget they will adopt, and we are working towards that. There are only two issues there. The Europeans and the Americans have not been able to come to a compromise on what is IFRS 4, that is standard relating to insurance contracts. And they are still fighting over what is called IFRS 9, which relates to investments. Now, these are the two major items which the IASB and the US Accounting Standard Board are trying to grapple. India has, as a policy, said we will converge to those standards, not adopt it. We are also working in that direction. The second is to bring about risk-based solvency in the insurance. At the moment, it is a factor-based solvency, and we have put 150 solvency as the standard, but it is not considered international standards now. We are trying to build in what is called a risk-based solvency, and we hope that within a couple of years we will be able to bring a framework of solvency which is applicable to India. Because if you start adopting the US or the European models, we find that they have better data and they have a long history of insurance. We have our own issues because we have rural and social service lending, and we have the fact that we have to put 50% of our money in government securities, and it's part of our mandate from as per the old insurance bill. So we are trying to work out a framework which will actually suit the Indian conditions. I once again thank the organizers, and it's a great privilege to talk in front of a person whom I worship. Thank you very much.
So Dr. Jalan actually wants to make an intervention, if you will. He wants to make a comment.
Yes.
No, thank you very much, Mr. Nair, for your kind words. I really appreciate it. You are most kind. No, the one point that I wanted to tell you, and which is not, you absolutely put your finger rightly on what happened during that period, 1987 and 2000. I think we're talking about 2000, when we had volatility and the market was tightened to a point, but interest rates went very high, and there was a lot of suffering about that. This is a very interesting issue, because I wanted to just highlight that from the macroeconomic perspective, sometimes the regulators have to take action which stabilizes and give confidence to the market that the volatility or the kind of fluctuations that they are seeing, or the kind of predictions that people are making, India will go bankrupt, that won't happen. This is how regulators think. Now let me just explain that particular point. It was a very deliberate move on the part of the Reserve Bank of India to raise interest rates to a point where people will not borrow. You know why? Because we were facing a tremendous foreign exchange problem. It was Asian crisis. There was this whole nuclear proliferation thing. So the US was against us. US controlled the IMF. There were no sources of money. Our reserves were very small. And therefore, what we thought, and this was done always in consultation with the government also, that you have to take tough action, and therefore the rupee, you remember, had become highly volatile. Because the market was buying the loan. It's not insurance company, but there was a tremendous pressure on the rupee. So we lost, out of say $20 billion reserves or something that we holded at that particular point of time, we lost $4 or $5 billion in 1 week trying to defend the rupee. Because what happens? It's not a philosophical thing. It's not an economic attitude or macroeconomic thing that you try and intervene. But the market feeds itself. If you are seeing that some of the major players in the foreign exchange market are buying dollars, everybody else thinks that rupee is going to depreciate. And therefore you buy dollars. And we could see this. And they thought that if they buy dollars, then the rupee would become, that the rupee is going to depreciate and you are going to sell, which happened. But what we had done as a policy measure was to reduce the credit to buy dollars. It was not supposed to affect but then the consequence of that is that everything is interrelated. But that was a very deliberate move. And as you say, there was no credit was there. The market became very tight. So the rupee became, we were able to handle the foreign exchange problem without having to run to the IMF at that time, because IMF wouldn't have been able to. So that I'm just explaining that sometimes there is a conflict between what we may regard as the financial interest or the market interest and the regulatory interest in trying to manage that the country doesn't break down, as happened in the US in 2008 because of not taking tough action. So sometimes tough action has to be taken, and we have to be prepared for it. The biggest priority from the macroeconomic perspective is to ensure that volatility in foreign exchange market is less. But if the foreign exchange market becomes volatile or speculative, then you have a problem. And fortunately today we don't have that.
Yes.
Because there is stability. You remember when we went to 68, everybody was saying, everybody was holding developments and so on and so forth. Then the market is stabilized. Or is this within a range? Fluctuation doesn't matter. There is no target. But then there is if you have to buy dollars or if you do something, you do it for concrete purposes, for your research purposes, not for speculative purposes. So this is like extremely important point you raised, and very rightly, that there can be a conflict between the market behavior and the regulatory behavior at the macroeconomic level. So from the perspective of risk, macroeconomics on which I was asked to talk, that sometimes unexpected can happen. And if you want to prevent it, the best thing is more stability. Sorry.
No.
Sorry.
Thank you, sir. Thank you.
The whole purpose is to have a dialogue, and I think this allows us to do that.
It's a very, very right issue.
Thank you, sir.
Thank you for that very interesting session. Our next speaker is Dr. C.S. Mohapatra, Advisor, Department of Economic Affairs of the Ministry of Finance, Government of India. He is a Senior Indian Economic Service Officer of the 1986 batch and is currently positioned as Advisor Financial Sector at the DEA. He presently handles all policy issues and matters of Financial Stability and Development Council, the FSDC, and the Financial Stability Board. Dr. Jalan talked about stability, so a perfect segue. And he looks after all financial stability reforms and policy issues. Prior to this, he looked after the Capital Markets Division and policy-related issues for 4.5 years in the Finance Ministry. He has held several senior positions in the central government ministries and departments with an experience spanning 28 years. Ladies and gentlemen, please welcome Dr. Mohapatra.
Good afternoon, everybody. Dr. Jalan, my role model and everybody else's role model. Whenever you start a government career, you keep thinking, can you come anywhere near Dr. Jalan? I'm extremely proud to be here, and I confirmed more than twice whether Dr. Jalan is coming. And I insisted that I must be there also in the session when sir is there. And as it usually happens, the government always have the last opportunity to talk, but anyhow government is the last word. Sir, I won't be able to get into the level of operational details and the enormity of the experience which you have shared. I won't be able to talk at an operational level or at a micro level, as the first speaker has talked about. Won't be able to give the regulator's perspective individually, as Badri or Nayan has mentioned. But I have been there, sir, in the capital market division from 2007 onwards. We have seen how we handled together the Lehman crisis. Today's topic is about having a perspective on the financial stability architecture. Let me tell you at the outset, an architecture can also be informally built up. That was the experience of 2007-8. When Nair was talking about the mutual fund crisis, at a very short notice, as director in charge of capital market, we had convened a meeting of all the bankers, the Indian Banks Association, the governor of the Reserve Bank then, and the meeting was chaired by the finance minister. Everybody together decided what course of action to be taken at a very short notice. However, it's very important to have a body, have a structure against which you can work. So at that point of time, what we did, decided to have two things. One is set up Financial Stability Development Council, and also have a commission to clear up the laws and reduce its anomalies for a longer term. Dr. Jalan talked about micro perspective and macro perspective both, also short term and long term. In the short term, we needed to set up the council quickly so that there has to be a body which can regularly look at things in a very organized basis. And for the long term, we set up the commission called Financial Sector Legislative Reforms Commission, which is supposed to give you a lot of comprehensive changes in the rules, regulation, acts, and bring about the unification, improve coordination, and also try to change things for better. Today, we have the FSDC, which very effectively handles the issues. But let me tell you, what can be the desirable points for good stability architecture? Any good financial stability architecture, to my mind, should have a solid institutional infrastructure base, should have a structure by itself. As we say in Sanskrit, Sariram Adyam Kanu Dharma Sadhanam. Before processing any religion, before processing any activity, you should look at your body first. Your body should be sound. So that's the body here. This is FSDC. There have been occasions after occasions, starting from the SEBI IRDA conflict on ULIP issues, and many other issues where regulators have a conflict of interest, so-called conflict of interest, which needs to be reconciled at a macro perspective. Apart from having a high level of interregulatory coordination, we need to set up an institutional infrastructure where we can have proactive discussions and share each other's experiences. That should be the number one desirability of a stability architecture. Then we should have acts, rules and regulations which are comprehensive. Nobody is new here in this room in terms of the anomalies that exist, in terms of the gaps that exist, and in terms of items falling through the cracks and creating things like Ponzi schemes and so many new things. We keep innovating, we keep handling them one by the other, after the other, but looking at the things in a bigger perspective, having a dynamic system of innovating and also changing your laws, rules and regulations is a very good point in any system. So the stability structure should have a regulatory system which is comprehensive, which is simple. Simple is the most difficult thing to get in this country. And any regulation we do, we should do the regulatory impact analysis. Any information we ask for, we should realize the need for that. We should make it very simple and we should be able to use it. Any new regulations will come in, we should know what impact it is going to cause, it is worth it or not. Besides, the stability architecture, as the name suggests, has to be very, very dynamic, transparent and disclosure based. We also know that we have to have an integrated system with minimum interference and not mushrooming of regulations which confuse the rest of the world further. Apart from that, the stability architecture should have international best practices also in mind. And I talked about the reporting standards, and Dr. Jalan also spoke about the Financial Stability Board. And India as a country is very active, let me tell you. Apart from FSDC, I handle FSB also. So we are very active in terms of pushing the international agenda or our commitments towards bringing or promoting financial stability in the G20 countries. And India, as Dr. Jalan mentioned, in terms of banking arena, we are much more comfortable than any other area. And we